and a leader, shaker, and mover in the VC conversation, whether in Jordan, Dubai, Sub-Saharan Africa, North Africa, and Khalil is really a close friend. Khalil leads the advisory practice in Jordan for Cross Boundary, a global investment firm. And he also served as an advisor and director at the Dubai Chamber of Commerce and Industry, where he helped a lot of SMEs, and he helped establishing a proper business environment in Dubai for that exact purpose. He comes from a strategy and consulting background with various companies, including Boston Consulting Group, Ernst & Young, PwC. And today our session is about how to hack the VC negotiations. So Khalil, without further ado, the floor is yours.
Thank you, Rizet. Great to see you all. Thank you very much for giving me this opportunity to meet some of you that I already know, but also a lot of the interesting people that I look forward to meet soon in person. So yeah, when we're actually talking, myself, Rizet, Gezan, and the team about an interesting topic, we thought this might be an interesting one because we believe that the VC negotiations are probably where things usually fall apart. And although a lot of the good ideas or the good startups that make it to a certain stage, they unfortunately fail to raise funds in the right time or probably in the right way. And so we thought we might address this challenge in an interesting way and think of ways where we can actually hack those challenges to help you achieve the results that you're looking for and actually succeed with your negotiations with VCs. So before I do start, I would like just each of you to note down maybe 1 or 2 points that you're really keen to learn at the end of the session, articulate it, note it down, and we can get back to it at the end of the session just to make sure that we've addressed your expectations and your sort of the outcomes you need to reach at the end of this course. So just 1 or 2 minutes, just note down your ideas, 2, 3 things that you really want to learn, you really want to address as part of these 90 minutes. Great. So before I do start, I would really like to hear of any of you. Cool. So somebody is sending on the chat. You can send it on the chat. That's also a good idea. Yeah. Evaluation. So Nadine, if you can just help in noting these down, maybe we can go back to them at the end of the session. Cool. Just before I start, any one of you has actually talked to VCs or investors in the past? Have you really started? Have you any experience in fundraising? Have you talked to investors? Anybody would like to share their experience before we actually get into this? Yes,
an iPass, please go ahead.
Good morning, everyone. كيف حالك Khalil?
Hello, Yazan.
So we did a pre-seed round with Flat 6 Labs, and recently we've been talking to different VCs for a seed round. Unfortunately, we're not very successful due to the current situation in the market where VCs are keen to see higher returns based on the interest rate given for term deposits and this kind of stuff, and the ecosystem in general. However, at the same time, they're asking for more traction, of course. So we're trying to build up the momentum and the traction by enhancing the number of companies. We'll work on onboard new customers, increase the transactions, so on and so forth.
Great. You actually addressed 2 or 3 points that are really important, and I'll speak about them in detail.
And I have one question. I wanted to write it down on the chat, but since I have the chance right now to talk, let me just, if you don't mind, of course, to ask you. There is always this balance between valuation of the company and our shares as co-founders. So sometimes, how can we balance between not over exaggerating with valuation so that in the next rounds, we don't end up with people, with VCs that are not willing to jump in this round because the valuation is too high, but at the same time, not to get our shares diluted. So reducing the valuation in order to keep VCs jumping in the rounds that I'm raising will affect my share. But if I do have a high valuation, I will maintain a good share, but still at the down the road, I'm gonna be like, I don't have any VCs interested anymore because the valuation is too high.
Yani, yeah, Yazan, you asked the $1 million question that if I have the answer to, I'll definitely make more money than now. But I think throughout the slides, I'll address some of these points. There is no one single answer for this situation. That's the trade-off between the strategic value versus the economic value, right? And that's the trade-off you need to establish as a founder. On the other hand, you need to make sure that you have fair valuation, taking into account potential valuation, but also you don't want to cannibalize yourself in the future with down rounds, for example. So all of these challenges are things we address as part of our negotiation. So there is no single answer for this question. It's a great question, but it's hard to answer in one way, but there are different ways to think about it, which we hopefully will address throughout the slides. And I think that will give you some insights to help you think through the situation. But there, unfortunately, that's probably the biggest challenge that we face due to various factors, like you said, which is, opportunity cost, market situation, supply and demand in the capital structure, and the capital map, the nature of the industry and the nature of the startup itself. So there are different things that we need to address. But that's a great question, and please hold on to it. If you don't get all of at least the guiding principles of the thinking process, we can address some of these points at the end of the slide. But I think I will address a lot of these questions throughout. Anybody else would like to share their experiences, their challenges? Because these are really good points that I've noted down, and I'll try to address them and sort of touch upon them as I continue in the discussion. Thank you, Yazan, for sharing. Great. So, okay. So I'll go on with my slides, and then maybe we can sort of come back to the discussion as we go. So, like I said, and I just sort of addressed the question that Yazan raised, there is no actually one way to hack the VC's negotiation. But I think the key rule for hacking the VC's negotiation is to actually think like a VC. So in order to be able, and that's the biggest challenge I face working with startups, entrepreneurs, SMEs over the past probably 10 years, is that they still approach VCs with the entrepreneur's hat, and they don't see the perspective and the lens of VCs. And that's where I think that miscommunication as the gap happens, and that's where the deal usually falls apart, because the discussion takes place is from two different perspectives. And unfortunately, due to the nature of a certain situation, the startups don't see how they can create leverage within the discussion and the negotiation. Whereas on the longer term, the startups do have higher leverage compared to the VCs because they are actually the value creator in the deal. So there is a lot that we need to learn in order to think like a VC. But the first thing I'll spend a couple of minutes on is just for those who don't know, most probably everybody knows what a VC is. The VC is, or a venture capital, is an alternative investment strategy that started probably early 90s, but then the first institutional VC started in 1940 that was established by MIT and a couple of financial institutions, financial investors. And it's basically, in essence, it's basically accessing capital using equity as a collateral. So it's like you're basically getting a normal loan, but with your equity as a collateral. And the value created here is much higher because of the risk that's typically taken. That's why VC firms focus on early stage, high potential startups that do have higher return, potential higher returns in the future, compared to the probably lower risk PE firms that tend to look at more mature companies with lower risks and lower returns, and obviously a different strategy where they create value within the companies itself. The structure, as you most probably know, the VC fund or the fund manager, who you typically refer to as the GP or the general partner, partners with multiple LPs, limited partners, to create an entity that's a VC, and that basically is your potential investor. This is a typical, this is just a background on VCs and how they operate. But I think since 1940, the VC world have been evolving a lot, and we've seen it changes significantly, especially in the past probably 20, 30 years, where technology started becoming more and more sort of prominent. Startups, we've seen crazy exits, crazy valuations, and that's becoming more and more a trend. We've seen a lot of evolution, obviously, in structures, instrument, investment thesis, but eventually the fundamental or the rules of the game are the same. It's risk versus return, and that should be your fundamental sort of guiding principle whenever you're discussing with a VC. You need to understand the trade-off between the risk and the return of a VC and that investment strategy. Venture capital has the highest, as I mentioned, has the highest potential risk, but the highest potential return. Now, a lot of you and a lot of us need to sort of draw the distinction between VCs and angels, because a lot of you are early stage startups. They tend to raise funds from angels, VCs, accelerators, and that's where I want you to be sort of cautious and conscious of the differences between these different types of investors and what they're looking for. So while angels are typically friendly investors who are looking for taking higher risk, potentially lower returns than VCs, or equal returns, but typically lower returns, VCs are institutional investors that not only can provide capital, but also strategic value in different ways. So they typically invest resources, they invest time, they invest know-how, they invest connections in order to help startups to scale and grow. The other point that I see most of the times and entrepreneurs don't pay enough attention to is the fact that the strategy of the VC or the end game of a VC is actually an exit. So you need to understand that when they're coming in, they're actually looking for the way out. And one of the key points that you need to be clear with yourself to start with, but also with investors, is what is that exit path? And you need to make sure that you make it clear for them and you are clear with it yourself. That's what they're looking for. That's what they need to see. And it's important for them to see that you're also aligned with that direction and you understand that path, that exit path. The other point that we also need to address, which I think speaks a little bit to the point that Yazan made, is that it's usually it's a high return game, it's a high stake game. Typically VCs are looking at, depending on the nature of the transaction, the stage of the startup, and the industry itself, there are certain high returns that they're looking at. Typically in VCs, we've seen them looking at anywhere between 25 or 20 up to 50%, and exit multipliers that vary between probably 2% in certain industry and special cases up to 60 and 70x, 2x up to 60 and 70x that we've seen in many cases. And like there are two transactions that I personally worked on where there was actually 80x exit multiplier, which means for every dollar that the VC invested, they received $80 in 5 years. So usually that's the strategy, that's the investment strategy they operate. They usually operate on 5 to 7 years payback periods. So the 50% return is on over 50%, 55 to 7 years payback period, and the multiplier they're looking for between 3 to 80 or 90x is something they're looking at the end of 5 years. And that gives them sort of, in a way, the boundaries of their thinking process. The other thing that we need to be aware of is that the nature of these VCs and the nature of these risk return metrics, or and the value or the dynamics of the deal really vary depending on the sort of the stage that you're raising in or that you're raising at. So there are, as you know, there are multiple stages. People refer to it as seed, series A, B, C, up to IPOs and exits. In different, usually and globally, the definition is that as long as you are not cash flow positive, then you're still in the seed stage. Once you become cash flow positive, that's where Series A, Series B, and so on come in. And that the more mature you become, the more stringent things would be, and the harder the discussion with VCs usually take place, because they're taking lower risk, they're expecting low returns, or they should expect low returns, but they still push for the higher return because you're still a startup. So there is also a certain balance that we need to strike between these different stages. Typically in Jordan, what we've seen is slightly different, and this is based on actual number and research that we've conducted. So in the value of death, where we've seen globally, is defined as the time bound or the time frame needed for companies to be cash flow positive. In Jordan, even if you're still cash flow negative, you still manage to get early stage institutional investors, and people still refer to it as Series A. The value of death happens anywhere between the sort of 1 million and above. Oh, sorry, that's a typo. It should be 1 million and above. And what we've seen is that there's a relatively easier access to capital in stages 2 and 3. And once you reach to stage 4, that's where more institutional VCs become more active. Because the entrepreneurs and the startups haven't yet been through fundraising cycles, I did not talk to investors, they tend to lack the skills needed for them to raise funds from institutional investors. There is a different dynamics that I would like also to address here, that because of the regional trend that we're seeing and that's happening in GCC countries, a lot of the startups are finding it easier to raise capital for early stage in countries like Saudi or Qatar or UAE. But then on the longer term, even though they manage to secure this funding, unless they manage to scale properly and create the metrics, the traction that Yazan had referred to at the beginning of the discussion, it will be hard for them to raise more from institutional investors. Yazan, you want to comment?
Yeah, actually, I have a question here with regard to the investment, let's say, ecosystem in the GCC in general, or let's say in KSA in specific. We're seeing a lot of valuations. As you know, Hunger Station right now has been acquired by other company, and things are happening in a very dramatic, fast way. But do you think, Khalil, that there is some sort of a potential bubble happening in the investor sector in Saudi Arabia? Because, for example, in our side, in the fintech and cybersecurity, we're seeing like a lot of companies that are being evaluated at $600 million in the buy now, pay later sector, for example, but still they are suffering from heavy losses. Yes, they have a positive cash flow, but like even SEMA is giving them a breather regarding their provision percentage. They're getting a lot of support, but in the sense of core traction, they're not doing that very good. It's more of a bubble, let's say halo effect impact. I don't know. So what are your thoughts on that? Given the fact that in the Jordanian ecosystem, we're suffering a lot. We're getting sometimes profit. We're not getting a lot of revenue, but we're achieving break even or a profit margin. But still, we're being like seen as the underdogs, and we're not doing that well. And Jordanian market is small. When you go to GCC, it's a different ball game. Things like that.
That's a great question, Yazan, and yeah, I think, and that's sort of my 2 cents take on it. What's happening currently, especially in Saudi, is not necessarily an efficient market dynamics. Doesn't indicate efficient market dynamics, and yes, the market is being overvalued, and that's why we're seeing a lot of commercial funds a bit taking a step back now, and we're talking to just recently, probably me and Rizé had a discussion with a couple of VCs in the region, and even one of them was actually one of the largest family offices in the world, and they're looking into the region and the emerging markets, and they can see that the Saudi market is not efficient in that sense, and yes, a lot of the startups are being overvalued because, and that's driven by the government money being pumped into the market through different investment vehicles, be it government funds or commercial funds, and that on the longer term, in my opinion, is not very sustainable. And as probably a lot of you are keeping track of the market news, if you looked at the recent data that just been announced recently, although the value of deals that took place in Saudi is higher, the number of deals that took place in smaller markets like the EU is higher. That means still these transactions are more efficient for the capital, and institutional investors can see that valuations in Saudi are being driven a lot by the access of capital provided mainly by government subsidies in different ways, but they're not taking, they're sort of taking a step back. They're more focused on more efficient markets like the UAE, for example, or Qatar, although a much smaller number compared to Saudi, but still, relatively speaking, if you look at the numbers per capita, and we did some analysis, the number of deals per capita or per value of deals per number of deals indicates a healthier valuation structure in these markets compared to Saudi. So yeah, this, in my personal opinion, there is a trend of overvaluation, but there is also a strategic agenda that the government is driving in order to attract more startups and entrepreneurs and sort of push the ecosystem to a certain direction. So, but honestly, I believe on the longer term, we will see correction soon, and that's depending on where the commercial capital that is looking at the region from the global markets and keen to come into the emerging countries and emerging markets due to regulatory reforms, the inflow of entrepreneurs, the availability of capital. So a lot of the commercial capital globally is looking into the region and they want to move, and they are still watching what's happening in Saudi. A lot of them are obviously joined forces with the government politically, but they are still skeptical in terms of deployment and strategy. They're more yet keen on more efficient markets like the UAE for that matter. I hope that answers your question. I'll take that as a yes.
Thank you.
Cool. The final thing, the other thing I want to address is actually the types of capital or the instruments that you can use. A lot of us are more commonly aware of or used to normal equity, which is common equity, whether through convertible notes or direct equity. But we've seen recently the markets becoming more and more mature, where other vehicles and other instruments are being used, which, to your point, Yazan, can help in managing that balance between diluting your equity versus securing capital. So recently, we've seen more trend in securing subordinated debt or venture debt. 3 or 4 of the largest venture debt providers in Egypt are now being recognized globally. They're expanding to the region. We've seen a lot in Saudi, Sharia compliant. We're even seeing a couple in Jordan. Mezzanine debt or mezzanine equity, which is like a blended finance instrument between equity and debt. Preferred shares, which is sort of senior shares to common equity. And the differences between these 4 different instruments or main instruments is usually the risk versus return to investors and the priority of payment. So, for example, subordinated debt or venture debt is more senior to mezzanine. However, it's subordinated. We call it subordinated because subordinated to normal debt, commercial debt. So from an investor point of view, they need also to understand where you fall as a company, and we'll address in one of the following slides how you can, as a founder, how you can think of these different instruments and where you should focus on your fundraising efforts, and what type of investors you need to address or to reach out to. In terms of the process, and I know a lot of you are familiar with the process. Typically, for a VC to take a decision or to deploy, to execute a deal, usually takes between 3 to 6 months, and that's from the opportunity validation point. However, usually there's a lot of effort where scouts or representatives in the market keep continuing with the pipeline and identify pipeline, doing initial vetting. And then once they find an interesting opportunity, that's where the opportunity validation takes place. Usually after the initial decision of an investment committee, they start the initial due diligence. Once initial due diligence is completed, that's where the investment decision takes place, and then that's where the deal structure takes place, and this is the term sheet signature. And then a formal due diligence takes place until the final deal execution. This process is usually 3 to 6 months time, and that's why we always recommend startups to factor in that time frame within their plans for the fundraise. The nature of when you discuss with investors, there are primarily 2 areas for negotiations. One of it is, the first one is actually control, and that's where you negotiate terms that has to do with the control of the company. And then the other part, which is the economic, which primarily focuses on the economic aspects of the economic terms of evaluation of the deal. So these are the 2 main buckets that usually we address in negotiations, and we will sort of touch upon most of those in the following slides. But in principle, when you discuss when we negotiate, you can identify whether that's a control point or that's an economic point, in order for you to see how we can maneuver around the negotiation process. So this is, in a way, just sort of a background for you, and just to give you sort of the fundamentals of how VC operate, what they look at, how they go and negotiate, and just some background before we get into the sort of the more detailed discussions on negotiation. But I would like to pause here and just sort of have a couple of questions, 2 to 3 minutes of questions, discussions, before we continue to the next slides. Yeah.
Go ahead, please.
Hi, how you doing?
Good, man. How are you?
I was just going to ask a little bit about venture capital that might be available for R&D, the R&D phase of certain concepts. Because right now, what I can see in the marketplace is that most venture capital is available for tech companies that are software related. We're working on a physical technology, which is basically we move water uphill without the use of any electricity. This is extremely novel, and this can change a lot in the world of water and power and the urban infrastructure. But what I'm finding here is that there are no VCs that are specialized in the engineering side of things. So, especially at the R&D phase.
Yeah, I mean, I would say the region. I mean, yes, there's a gap when it comes to the ideation stage support and access to capital for companies that operating in the ideation stage, especially in certain sectors. We've seen, however, and to caveat that, we've seen a lot of them being funded by big companies operating in the region that do have a vested interest. And I personally worked on a couple of examples where back in Dubai, where Emirates actually have invested some money in potential startups that can actually address some of their challenges. So my take on this would be, you're right, there is a gap when it comes to supporting R&D and startups in the ideation stage and proof of concept stage. A lot of them do seek investments from angels, family offices that do have a vested interest. But I've also seen a couple of deals taking place, or a couple of transactions, a couple of investors that are coming in from the corporate world, providing finance for similar ideas. So my initial reflection is that try to scan the market and just to see who might be a good potential customer for you, or sort of user for that technology, and then approach them to explore the potential partnerships. But I know that in Jordan it might be limited, but I've seen the GCC becoming more and more sort of prone towards things like this. I'll be happy to have a more detailed discussion with you later on as a follow-up, just to sort of guide you through some of the ideas or some of the people I might be able to connect you to, or just some insights just think through with you on that. But yeah, you're right. I mean, the region is still behind when it comes to supporting companies at the ideation stage.
Thank you, Khalil and Charlotte. Shadi, please go ahead.
Yeah, thanks, Khalil. I want to ask about the, okay, in the previous slide, you have presented for us the range of investor, which is, for example, from 200,000 to $1 million Jordanian dinar. So my question for the valuation, I have, during the last months, I've been reading a lot of articles for the pre-seed stages when you still pre-money valuation. So I have seen two approaches. One is some people measuring the runway for this phase until the next one, and the other people looking for a benchmark for the last 3-4 startup in the same sector. What do you think the right approach? Because I've been thinking about and evaluating at least for 3 months. What is the right answer, do you think?
Sorry, Shadi, just to make sure I understand the question. So your question is, what is the best way to evaluate the company?
Yes. What is the right model or the right approach? To know exactly what exactly the reference point you, then I can at least know where I am, where to start. And
so, I mean, there is no right or wrong when it comes to valuation. It's a combination of things, and there is different nuances when it comes to reaching the right valuation of the company. I mean, like we said, cash flow is one point, multiple is another, comparables is another. So there is a lot you need to factor in. For example, and I want to get into details, but just to sort of think with you. So what industry are you operating in?
HR tech.
HR tech. So it's a tech company.
Yes, for sure.
Okay. Is it a SaaS or what kind of tech? Deep tech?
Till now, it's combination between SaaS and marketplace.
Okay. And are you cash flow positive, cash flow negative,
still
revenue generating?
Pre-revenue still.
Pre-revenue generating. Okay. So in that case, then we can't use cash flow, right? So we are like, for in your case, it's a very early stage. In most of the times, it's a higher risk that the investor is taking. So we can look at multiples, like you said, we can look at comparables, and we can look at projected cash flow that we can use for our valuations. It's very hard to give sort of an answer for the situation, but I mean, it also really depends on the nature of investors you're talking to. So if you're talking to an angel investor who might be willing to, I'll take the risk of 100K, I'll give you that 100K, that will give you 5 months runway, see where that takes you, versus a VC that's willing to come in early stage for a bigger ticket and might look for a lower valuation in return for more added strategic value like connections or know-how or technology or whatever. So the valuation question is honestly most of the challenging questions we get, because there is no one answer. And in many cases, it's also driven by the investor's agenda rather than the startup itself. So that the investor wants a 5x return in 5 years or a 10x return in 5 years. They will only look for deals that will give them that return. So you might have the best startup in the world with the best technology, but it's not aligned with the investors' sort of investment strategy and exit strategy. So it will be a no. So in that sense, it's a really there are different nuances. One of the key things that you need to do is actually do your research on the investors that are a right fit for you at this stage, and just based on the sort of the high level discussion that, or the high level insight that you provided, I think we're looking at an angel stage where you really need, what you really need is to sort of extend your runway for a few more months until you secure your clients, so you become cash flow positive or at least revenue generating. So in my opinion, this will be an angel, sort of an angel investor play. But then again, there will be different nuances that we can discuss. And Rize, if it makes sense, I don't know. I don't really know how the cohort happens, but I'm happy to schedule at least a weekly visit with the team in the core. Sort of, I can
Khalil.
have
And for and for all of you guys, you know that you can ask for a mentoring session with Khalil one-on-one to ask specific kind of bespoke questions on your startup. And any of our facilitators could potentially be a coach for you guys. So please feel free to schedule a one-on-one session with Khalil through Airtable, and Nadine can help you out. Okay.
Sure, and I'll be happy to look into this in more detail, Shadi, and just give you some insight.
Thanks, Khalil. I do appreciate that.
Great. So now getting into the sort of the negotiations, and I'm curious to sort of collect some initial reactions or reflections on this. So in your opinions, when do negotiations start?
Ask those who has raised. So Yazan, Qasim, tell us. Ayy, subhanallah.
Hello.
So again, the negotiation starts actually after the due diligence that happens. So basically the initial due diligence, post that, we start talking about the percentage, the amounts, for example, in our side, it was more of an accelerator and VC. So there has been discussion on the commitments. There has been discussion on certain things. Right now, we're talking also to Oasis 500. Also, the due diligence is post initial due diligence. Also, the negotiation starts, and I think it stays until the moment we sign the contract. So even in the contract itself, there is certain negotiation about specific terms. This is doable. We can do that. We can do that. So I think post the due diligence, after they realize that it is an opportunity and they're interested in it, from that point on until we sign the contract, the negotiations never end.
Amazing, Yazan. Thank you. Maha, go ahead, please.
Hi, Khalil. Hi, how are you? Actually, actually, just to simplify it, I think you start when you don't need it. And you enter into that negotiation mode when you're not in real need of it.
That's a really interesting insight, Maha. And yeah, that's a very interesting point. I mean, I have a point of view that I'd like to share, and I think that's where typically we believe negotiations start. But it's good also to just hear your views. Like Yazan has an interesting point. Maha, I like your point a lot. I think, I totally agree. I mean, there is a lot of, you change sort of the context of the negotiation when it's like when the leverage is different. And yeah, that's a really important point. Any other thoughts on when do negotiations start? Cool. So Actually, negotiations start when you first pitch your startups to investors. That's where you actually start your negotiation process. And the reason is, and speaks to the point that Maha raised, the negotiation is a trade-off between strategic value and economic value. And while to a certain extent, at the shorter term, the capital provider has the leverage when it comes to the economic value, you as an entrepreneur has the leverage or you need to create the leverage in the strategic value on the shorter term and the financial value or the economic value in the longer term. And that only starts when you actually first pitch, when you have your first meeting, your first pitch to the investors. That's where you create your positioning and you create your leverage. This is where you need to showcase your strategic value and your potential economic value to the investor. And you tell him, okay, this is what I can offer you in return of your economic value. I have added value to your, and I'll give you a certain bang for the buck, and you will give me a certain added value, and that can be both strategic and economic value. So keep it in mind, your first interaction with an investor is actually where you first start negotiating with them. So what does that mean? What does that mean? And there is like a simple framework that we use in, sorry, I'm just trying to deal with the tech here. Yeah, again. There is a simple framework that we would like to sort of use as part of our negotiations process. And we've used this framework as what, like, as the sort of the thinking driver or the thing that to drive the thought process with a $50 million transaction that we've been part of in the past few months. And it's basically a trade-off or sort of the balance between, just to help you think between what the bargaining power is, which is the x-axis, and that's basically the financial value, versus the synergy, which is the strategic value. Ideally, in any negotiations, the top right box is where you need to position your negotiations with investors. And that's the ideal situation. And that's, if you look at this axis here, which is urgency to close, willing to negotiate, that addresses the point that Maha mentioned, which is when you're not really in need or not really desperate for the money, there is a lot of strategic synergy between you as a startup and the investor. And there is a lot of financial value that you can create for the investors in return for their money. And that's where you need to position your negotiation. That's where you have power negotiation. That's the ideal quadrant. You have certain strategic value that you can add to the VCs, and the VCs have certain economic and strategic value that they can add to you. You're not really desperate for the money. You have a reasonable runway. You're not really willing to negotiate much on what you believe in. That's where you need to position yourselves. The exact opposite of this quadrant is basically the down left quadrant, which is name the terms. In this case, you as a startup, there is limited strategic value, there is limited strategic alignment between you and the fund or the investor. In this case, the investor probably has a certain quota they want to achieve or a certain investment thesis they want to deploy, they're testing, or even you have certain economic value you add to them, but it's not great. That's where they will take a lower return and maybe a higher risk in return of a potential future terms. That's where the terms of the term sheets usually become unfair for the startups, because that's where the VCs or the investors want to sort of secure lower follow-ons, lower valuations for any next round, preferential liquidation terms, sort of preferential preferential shares. There's a lot of term sheet negotiations that take place. This is where your term sheet becomes really a challenge, and it's relatively unfair for the startups, but because of the situation they are in, they have limited bargaining power, the returns are low, they don't add much strategic value to the funds, and that's where the funds usually have an upper hand over the start. If you look at the strategic negotiations, that's where I think it's more of how the startups or the entrepreneur can leverage their strategic value with the VCs. That's where you really need the money. There is a lot that you can add from a strategic point of view. A simple example would be, okay, I'm a VC that have a portfolio of tech companies, and I find that AI company that fits within my portfolio, and it can create sort of a platform where all of the other startups can leverage, so I can integrate, then create higher value, exit. So I need, as a startup or as an entrepreneur, understand that strategic value, that strategic alignment with the VCs, and how I can leverage it in order to get fair valuation, fair terms for me. The exact opposite of that is basically when it's a pure financial negotiations. That's where there is no strategic value. Basically, you just need for cash. You need to close your round. You already secured most of your funds. So it's just basically, you have the bargaining power there. The investor can see the potential. There is a high return. So that's where you sort of name your terms as a startup, because you're not really desperate for the money. You know that you have your terms. The investor can see the returns that you can generate, and then you have that bargaining power. That's a pure financial negotiation. Pure takes place with so usually the startup has the upper hand, and we've seen one or two examples actually in the past few months in Jordan, where actually the startup is driving the discussion with the VCs on certain valuations or certain things. So this is sort of like the high level framework that you can use to understand where you fall and try to position yourself always in the top quadrant to have power negotiations. I'm gonna pause here because I think there might be a lot of questions on this framework. So before I go, so I'd like to just, have a discussion with you, your feedback, your reflections, questions on this framework. You think it works? If not, have you experienced it? I mean, just sort of have a discussion on that for a few minutes.
Any questions, guys? Clarification? You can move ahead, Khalil.
Yazan has a question.
Just a quick question here, Khalil. Would you advise us to, for example, in our case, we're building more of a traction. So we're getting there, we're moving down the line and getting the traction we want. But do you suggest that we start approaching VCs once the traction is there, given the fact that in that case, the willingness to negotiate would be lower because we have more cash in the runway? Or should we start now while we still don't have the proper traction we're seeking? Like, can you just map it out for me just to know when to start? Given the fact that, of course, that the negotiation takes from 3 to 6 months, usually in the MENA region, it takes more even than 6 months. They forget about you for a couple of months because end of year, Eid, Ramadan, things like that. You never know when you start negotiation, when that time slot will happen. So what's your advice on that?
I mean, yeah. Ideally, you only raise when you think it's the right time to scale. You need the extra cash to scale. I mean, in many cases, raising works the way, like, let me put it this way. If you really have a funding gap in your financials, that if, for example, you pump in $1 million today to achieve 5 times the growth that you can achieve yourself with bootstrapping, then I would think before I start fundraising. It really depends on your current funding gap. And that's a really important term that I still think that startups don't see it. Versus, okay, if the funding gap that I have today is, let's say 500K, if I pump the fund at 500K today, my growth will be cut by half compared to me bootstrapping, pushing myself to achieve the traction that will put me at a valuation that I'm comfortable with. So it really depends on the multiplier effect, or the sort of the Vernier reaction to calibrate your funding gap and the relationship with the growth. Let me try to simplify it. I know it might not be the simplest answer. If you do have a runway and you have growth, and you can sustain with that runway and that growth for the coming few months, and based on the projections, you know that I'm not achieving the 5x growth that I want to achieve, but I know that I'm cash flow positive, I can sustain, but I can see in 10 months, my revenues will be doubled, and that's where I can do my valuation at lower risk, higher returns, and that's where I can set on my own terms. Versus the situation, the scenario where I have a funding gap today that's really gonna drive my revenues starting tomorrow with 10x or 5x or 3x or whatever it is, that if I can secure at the moment, in few months, on the 3 months, my valuation will go. It really, like, you need to have, and that's something I would like to address in the following slide, building your financials is the first step towards identifying when is my capital raise have to be, or when should I start raising. Your financial projections is the answer of your question. Regardless of how much it takes, 3 months, 6 months, that's something you factor in. But if you do project your revenue and cost drivers properly, you will be able to sort of identify the point where there will be that high growth that you will achieve if you get that critical amount of cash to accelerate the growth. It's a decision you need to make based on your financials, that funding gap and its impact on your revenues. And when you sort of build your financial model, I always recommend startups to have that cash flow statement within the model as accurate as possible, because within that cash flow statement, you can sort of, the way we do it as part of our job is that we have this funding gap dynamic as a box, so you can change it as we want. And then when we change it, automatically the cash flow changes. And then we can see the impact of the cash today versus the impact of cash in 3 months, 6 months, and so on. And we do that test in order for us to assess when is the right time for a company to raise capital. I don't really recommend any startup to raise more than 500K to 1 million max before they actually start reaching a certain valuation that they're comfortable with. But I know a lot of people see it as a success story that we've raised that much money. It's not necessarily a success story. A lot of them now are struggling, can be struggling with down rounds, with investors that are not looking to come in at these valuations and so on. So the answer to your question would be building your financial model with a dynamic cash flow structure that can help you sort of plug in the numbers at certain times and then see the impact on your revenues.
Do you think that a good justification to raise capital is a potential business opportunity that requires the funding?
So acquiring a different company, that's what you mean?
Sorry?
Does that mean you're acquiring, so a business opportunity is basically you as a startup finding another startup and acquiring it?
No.
What does that?
It means like we have a business opportunity. Our current capacity is insufficient to cover that. So if there is this opportunity, surely we need to provide the service prior collecting the money. Therefore, we need investors to pinch in. So this could be an example of a financial gap that justifies the raising of the capital.
Of course, and you can model that into your model, because the investor would want to see, if I'm putting 500K or 1 million, where it's being spent. And when you show the amount being spent in your financial model, the amount is being allocated to certain expenses that drive the revenue. For example, you're deploying more employees, developers, you're investing a little bit more in certain market, you're investing in technology that you need to acquire in order to drive certain traction, or investing in certain marketing tools. So yes, in that sense, your cost, your revenue is a function of your cost in a certain way. That's why, I mean, when you develop your financial model, your funding gap is a function between your cash flow versus your cash burn. And if the ratio between your generated cash flow versus your cash burn is one key metric that an investor would look at. So what is the ratio between that cash flow that I'm putting, or the money that I'm investing, versus the revenue? That's how you will sort of have the right funding gap in your model. But it's a valid ask. Yes, I want to raise 500K in order to drive the growth, and that will cover my expenses, and when it comes to employment, marketing expenses, and so on.
But so that will reduce my bargaining power, of course, because they will feel the sense of urgency.
Depends on the investor. Yes, depends on the investor. These are all frameworks. Yes, he might see that you're in urgent need for the cash, and that's where they want to leverage. But you also can be sort of talking to different investors and leverage that against the investor as well. So, with investors, you really need to do your homework in understanding what they're looking for. Are they coming in for the money? Are they coming in for strategic value? What is it that they're looking for to drive the discussion using their agenda? But to your point, the right time to raise money is when the value of the invested money is going to multiplied in the short term rather than the long term. And that is where your financial model, especially your cash flow statement in your financial model, should show that funding gap, and should show what is the ratio between the money that I'm investing or burning or expensing versus that revenue. That ratio is probably one of the key metrics that myself as an investor would look at when making a decision. And that's why, for example, SaaS companies are very popular because of that ratio. So all of these questions are valid questions. The answer to these questions would be in your financial model. And I'm just conscious of time, Rizet. So should we just, I know there are a few, type. Cool. So go ahead, sorry. We still have 20 minutes, right?
Yeah.
Cool. Right. Just on synergy, and I think, just on synergy, I think there are 3 things that you can look at, or like sort of 3 main brackets that define the value that an investor can create, or the deal can look at, or both of you as an investor, as a startup can look at. First is the capital, and beyond the economic capital, there are also things that you need to look at when you talk to investors. So their commercial capital, when I say commercial, it's not only the economic value that they provide, but also other potential facilitation capabilities that can help you become commercial. Something like helping you in building a proof of concept, or so how they can help you commercialize your product. Sometimes it's regulatory, sometimes. So there are certain commercial value that they can bring to the table, and this is not necessarily the economic value, which is the capital they can pump in. The reputational element as well. It's always good to have a reputable institutional investor on your cap table, that shows credibility, that shows other investors that, yeah, since the leader of the market is investing in here, it's also good for us to be there. So I always recommend startups to find a good institutional investor to have on their cap table before even starting the fundraise. And this is where, for example, I tend to accept certain trade-offs on commercial value or valuations to get a reputational, the reputational element to my cap table. And finally, the emotional. It's very important to have certain synergy, and this speaks a lot to impact investments, for example, where there are certain set values, priorities you would like to have, a certain personal relationship that you like to have with your investors. There are certain religious, sometimes cultural aspects that you can sort of address as part of the strategic value that an investor can create. The other component is actually contacts. We've seen this a lot in the GCC in particular, where startups are scaling to GCC and sort of accept certain terms or certain structure or certain valuation to have someone on their cap table or investor on their side that can help them find contacts and connections in markets that they are new to. And finally, cognition, which is understanding your business, understanding the value, and sort of being able to add expertise and knowledge to your startup. It's very important that you have an investor that really understands what you do, what you stand for, and really can add value to it from a both tech knowledge, experience, and even sector and sort of governance point of view. So these are three things that we really try to look at when we evaluate what kind of investors is the right investor for this company. So there are when we start negotiations, there are a couple of points. I think I addressed the financials as part of my response to Yazan, but I would try to address it in more details now. But when you start pitching your investors, that's where you actually start negotiating. Keep in mind that angels generally invest in 2.5% of the companies they evaluate, and VCs invest in only 1% of the companies they evaluate. So you really have to stand out when you sort of start talking. The moment you start talking to them, pitching to them, you really have to make sure that you stand out. There is a well-known saying in the VC world that they say your deck should be so good that a VC asks you for your permission to show it in his or her portfolio company. So that's how impressive you need to be when you pitch. So master your pitch as much as possible, master your storyline, master your value, make sure you have, there's a lot of research and content, a lot of people can help you in building your pitch deck. Make sure that you have the structure. There is a lot of data on how you structure your pitch deck, the mission, the purpose, the problem, the solution, the market, the opportunity, the competitive analysis, all of these components. A lot of the team, obviously, you need to highlight, depending on the stage that you are in, highlighting the team versus highlighting the startup itself, how you can focus on future versus actuals, there were financial projections. Even to a certain stage, sometimes we even address exits as part of our pitch decks. So it's really important to master your pitch deck, master your ability to deliver the message to the investors the moment you start talking to them, and that's how you start creating the leverage in order to position your negotiations on that quadrant. Keep that quadrant in the back of your mind. That's where you want to position the negotiations that you do. The second point is I sort of addressed with Yazan, is master your financials. This is an example of some of the financial models that you need to have. I'm sure you're all familiar with it, but one thing I would like to address as part of your financial model is basically this sheet. This is something that a lot tend to undermine, but it can be as important as your revenue projections and sometimes even more. So your operational metrics and profitability metrics, your unit economics, are as important as anything else in your financial model. Mastering those, making sure that you know them, you understand them when you pitch to investors, to understand your unit economics is as important as the startup itself or the pitch itself or the valuation. A lot of the startups we talk to, when they start pitching to investors, they show that they don't understand their financials, and that's where they lose the battle. It's really important for you to understand your unit economics and know that it is very important for the investors to know that you know it, and it is appealing for them. It is as important as your revenue projections, your growth projections, your margins, and so on. That's a really important aspect of the funds. And being able to present it comfortably with it, answer questions on your margins, growth rates, daily users access, monthly average users, ARPUs, all of these important metrics, whether operational or financial, should be always at the back of your mind when you pitch to investors. So you really have to be prepared when you pitch, not only from the storyboard or the pitch deck, but also the financials. And that's where I always recommend that even like sort of the founder needs to have his finance team obviously next to him on the calls or the meetings, but it's very important for the founder to be able to present it. It's obviously it's good to have your team, your CFO, your ever financial manager on next to you, but if you're not able to present it as a founder and as the owner of the idea, you lose points with the investor. It's really important. The other point that's also very important when you talk to the investors is what kind of investors are we looking for? So understanding the people, the personas, understanding the VC itself, what they're looking for, speaking their language, understanding what they're looking for when they invest, what kind of returns, why they are investing, why they might be interested. Is it the right stage for them? So, I mean, a lot of people have a list of potential investors or potential VCs in the region, and they start talking to them left, right, and center without really knowing who are the right investors for this stage, for this ticket size, for this industry. And this is really something that really makes a big difference, because you start burning bridges, and the market is very, very small. Most of the deals in the market are visible to almost all the investors. So if you start burning bridges early ahead, you might lose on the long-term game. So make sure you sort of you do your research on the investors, what is their focus, their stage, their investment type, their investment focus, ticket size, and so on and so forth, and do some research on the people you talk to. A lot of the times you meet initially the sort of the scout, and then you meet the investment manager, and these investment managers are usually have different ways to talk to them. So a lot of them, they like the story type, a lot of them, they like the impact story. So really do your research, and a lot of the entrepreneurs talk to each other and share experiences. That's a really great way to collect data on your before you pitch. Try to see someone who actually pitched and was rejected, try to get some insight, or pitch and actually succeeded and get some insight. It's really important that you do your homework before you actually get into the pitch. They start pitching to the investors before even the negotiations. Your first interaction with the investors is actually the most important one, because you really need to create the leverage to put you on that quadrant. Cool. So this is on the negotiation process, the dynamics, the structures, and more on sort of like the soft side of negotiations. I'm going to address, I know I have like around 15 minutes. I'm going to address in more details, like the sort of the hard part or the financial part of negotiations, which is not the financial, I mean, like sort of the less enjoyable part of the negotiations, which is term sheet negotiations. So we'll go through some of the terms, I'll try to address a couple of different instruments. So like normal equity investors versus mezzanine investors. So just to go through the terms, make you a bit more familiar with term sheets. What are the control terms versus the economic terms? And maybe I'll see if we can have an actual example of a term sheet that, so we can walk through together. But before I do that, let me just pause for like 2-3 minutes for questions, reflections, discussions, and then we can start the term sheets negotiation part.
Any question, guys?
Hello. Hello.
Yeah.
Can I ask how can we contact you for one-to-one meeting after this session, inshallah, to speak about our project in specific?
Ruba, you can book through Nadine and Airtable. So Nadine can help you out in that. And are you a startup, by the way, Ruba? Are you a
Yes,
startup at the core? Which
yes.
startup are you?
We are Khalil.
أنت مش معنا بالcohort.
No.
Sorry, we can't do that. Maybe we can discuss that later. So any question?
No worries,
Yeah,
but even if it's paid, مثلا?
We can discuss that after the session.
طب how can I don't have any number for all of you.
We'll reach out to you. هلا بخلي Nadine to follow up with you.
خلاص, great. Thank you. Thank you.
Maha, please go ahead. Maha. Okay.
Can you hear me now?
Yes, we can hear you.
Okay, thank you, Razak. Okay, Khalil, I have two questions actually. The first one is like anything else. يعني أي حدا, the first impact or the first things that they read is the most important to get them interested to continue or to be with you. So as a VCs, what's the first in the pitch deck that you need to focus on to get that attraction? That's يعني the first impression that may, if I may say. And the second part is basically, in my case, okay, the startup is basically started getting business and rolling, yet the team is not established yet. Yani this is in the process. So since the VCs always think about the teams as number one priority, do you still think it's a good time to even to start talking or negotiating to VCs, or no, build your team first and then talk to them? Thank you.
Thank you, Maha. Well, that's an interesting question. I think one thing, just on the point where teams are important, and the reason VCs are really keen on looking at the teams, is that the belief that the right team can pivot and keep pivoting and trying and experimenting until they reach to a certain product. So that's why in most of the cases, for example, if you have a serial entrepreneur, an experienced entrepreneur that had multiple exits on board with the startup, it gives investors certain confidence that he was able to do it once and twice, and he will be able to like sort of move from a product that's not really great to making it a really profitable, good startup with a great product and so on. So that's why the team is really important, because they believe that if we have the right skill, we'll be able to pivot and pivot and pivot until we reach where we are or we want to be. On the point of what is really important, I think one of them, there is no single one important point, but I think a couple of things that investors tend to look at is first of all, how big is the problem? That's really important, because I mean, if you can address a bigger problem, that's a bigger TAM, and so that's really important. How scalable it is, and so if you have a solution, how easy you can scale, how easy you can implement, how easy you can reach out to customers. That's the other point. The team is obviously very important, and the final one is probably just making sure that you understand the market you operate in. So who are your competitors? What market are you trying to achieve? You know your go-to-market. Sort of these are the 4 points that myself as an investor would look at before even looking at the financials. So if I know that problem is really it's a real problem that has a big scale problem. The solution you have is very scalable. It's something that can scale up easily. It's not going to require a lot of huge hardware investments, or it's really scalable. And then you have the right team to implement and to drive. It's not necessarily a big team, but typically investors like to look at founding teams between 3 to 5 people. They hate to find single founders. They don't believe in single founders. 2 is sort of very limited because you have sort of at least 3 to bounce an idea. So 3 to 5 is typically what investors would look at from a sort of team's point of view. And the final point would be more on the market dynamics. So who are the competitors? What's your market, go to market? What markets are you addressing? What type of customers and so on? So these are the key 4 points. In your case in particular, I wouldn't say that. Yes, it's obviously great to have a co-founder, and because I'm a little familiar with what Matt is trying to achieve, just for the context of everybody. So it's good to have someone with you as a co-founder. You don't need a big team in your case. But what you would actually need is a successful proof of concept implemented.
Khalil, may I add something?
Yes, of course, please.
Maha, more or less what Khalil has just mentioned.
Yeah.
Is what we look at when we do assess the investment readiness at the entry and exit for you guys. So if you go to the investment readiness assessment that we've done at the beginning of the journey, you can find 7 pillars. Under each pillar are 7 sub-dimensions that we look at in order to assess your investment readiness and thus reflect those as key focus areas per startup to work on to make the startup more investable for venture capital funds. And if you want to relook at it, we can send it out for you.
I have it, but actually also another question came, like when you're saying 3 to 5 people so that they can cover the multi-main functions. But what if these functions are already there by an outsourcing of either partners or not within the company, but yet they're fulfilled, like maybe the technical or the accounting and audit or whatever. It's just outsourced rather than inside, and it's a very clear coordination or partnership or whatever. Will that cover, or we're talking about real people inside full-timers?
Sorry, Maha, is that question to
Khalil,
me or to Rizal?
Yeah, it is a question. I'm just asking.
No, I'm not sure if it's to me or to Rizal.
No, it's the question is very simple. Is if we do have a team, but not within the staff. If I have them as, for example, a technical arm that I'm partnering with, or the HR is outsourced, or and the marketing is outsourced. So, and there is of course somebody on top of it. The founder or whatever, if I am on top of it, and there is another person or whatever, but from the beginning, you don't want to incur a lot of employees rather than outsource some features until it goes into another level where you really need a full team on board.
Yeah, that's a classic question, Maha. And yes, typically it's normal and acceptable to, for example, to have your tech sort of arm outsourced. You basically have a company that basically develops the products for you. But as you start sort of becoming more and more mature, it's important to have that ownership of the tech within the company itself. So for a proof of concept, for early stage, we've seen a lot of examples where the tech was developed through a third party or through a contractor. And yes, maybe the co-founder is a tech guy who has sort of experience and he drives the process with the development company. But as you grow, it's always recommended, and investors would see that as a red flag if you don't have your tech team within the company itself. So starting, it's normal. As you grow, you need to have the tech owned by the company, and like the full ownership of the development of the product as you grow will become really necessary for investors to make sure that you own it.
Okay,
But
thank
at
you.
early stage, that's very acceptable. That's normal. We've seen it a lot, and even with like big companies, you'll be very surprised. Who are unicorns now? They actually started the sort of their startups with the startup being developed by a third party, and then they owned it. So it's normally acceptable. We've seen it, but as you grow, you need to plan to make sure that you own it within the team and you have the team to buy it.
Oh, thank you, Khalil.
Cool. I know we're almost there.
Guys, before we proceed. Okay, we're good to go, Khalil.
Yalla. I'll try. I know a lot of you are familiar with the term sheets, so I'm not gonna drill a lot on these terms because and we can have one-on-ones just to discuss specific needs you have. But I'm just gonna try to address in the next probably 5 to 10 minutes just the broader sort of structure of term sheets, and make sure that you're comfortable, familiar with it, with the lingo at least, and then feel free to like schedule one-on-ones for specific questions you have. The first, just going back to the structure, as I said, there are different ways that you can secure funding. It's not only equity. We're seeing more like a lot in the market recently, especially Jordan and GCC, where other instruments are being used. So you don't have to dilute a lot from your equity because you can basically secure funding in different other ways. So keep that in the back of your mind, but always understand the risk versus return and the trade-off and the priority of repayment as sort and versus the dilution of the cap table. So these are just some examples, and if you reach out, I can tell you where you can sort of some of the providers of the different types of investment instruments. Now, in order for you just to sort of decide how you want to raise, that's a simple framework you can actually use. So it's basically, it looks at two things. The first one is on the x-axis on top is what is the exit potential. So obviously there are certain companies, brick and mortar, FMCG, retail, that are looking to raise, but do not necessarily have big exits, versus SaaS tech companies or the deep AI companies that have higher potential of exits. So this is your first, and then you need to map where does your business fall. It can be a simple kindergarten project, or that falls on the far right of the spectrum, versus a deep AI tech company that falls probably closer to the far right of the spectrum. So that's your first parameter. The second parameter is basically ability to generate cash flow. So the more secured, predictable your cash flow is, the easier for you to get a debt-like instrument with certain returns. Most probably in certain cases, reasonable returns versus slightly higher returns when in certain cases where there is higher risk, but at least you're not diluting a lot of your equity, compared to the higher risk that an investor is taking, which is an unclear path to provide cash flow. That's where the early stage startups typically fall in. So, and the blue box is primarily the debt-like instruments, which it can be subordinated debt, revenue sharing, mezzanine, convertible notes, and sort of convertible debt, and redeemable equity. And the red box is basically more of the equity instruments, redeemable notes, convertible notes, preference equity, and the common equity that we own. So this is just a simple framework for you just to get a feel of what might be the best instrument for me to raise capital with. In most of these cases, you need to negotiate, obviously. You negotiate returns, valuations, conversion terms, conversion rights, caps. So there are always different negotiation terms, but the most common ones that we usually look at, and just trying to skip for the sake of time, is basically, to start with, is the nature of the security itself. As we said, there are equity, mezzanine, and debt. In all of them, you need to understand your valuation, dividend policy, liquidation preference, redemption or repurchase rights. That's very important in equity because it gives this sort of gives the investors the right to buy back or buy or put out their shares. It also gives them the right to sort of to protect certain investors sometimes, so they can rebuy or reinvest at lower rates sometimes. So that's really important to understand. The other part of mezzanine, and for those of you who do not understand what mezzanine is, this is a combination between debt and equity. So basically, and the transaction is to a certain extent de-risked by a small equity buy. So the investor has the right to convert, sometimes to convert the note they have to equity, which sort of reduce the risk, but also it gives them a certain repayment plan, so you don't have to dilute. So to explain that a little bit more, so I invest in mezzanine because I will get returns from the company, and I have the right, in case the company fails to pay me my debt, to convert my note into equity. This way, if you pay your money back, you don't dilute. However, you owe the investor the right to pay him back his money. And in many cases, it can be the form of structured returns, where it is based on a certain plan, versus revenue shared return, which is much easier, but concerns our return. So if you're not able to pay back because you're not making a lot of money, it's easy. It's not going to put a lot of pressure on you as a startup, but it's sort of, when you make money, it will be higher returns for the investor. This is on the control side. So protection mechanisms, which is basically anti-dilution, that prevents you as a founder to sell your shares for a lower price, so to dilute the existing investors already. Preemptive rights, drag along and tag along. These are all protective mechanisms to protect either major investors or minor investors. Rights of first refusal, basically that you cannot sell before actually selling for the internal sort of investors, existing investors, and transfer restrictions. On the mezzanine, the control is primarily on the sort of the guarantees itself and what the credit pledge are. Basically, the equity or the sort of the collateral and the guarantee in terms of shares, negative covenants, affirmative covenants. Cool. Let me go through this quickly. I know we're like 3 minutes. So some of the key points that we need to understand whenever we're discussing negotiations. So when it comes to equity, its valuation, dividend policy, optional conversion if needed, liquidation preference, that's really important. That's one of the most important terms. Put out, call out options. These are all important for minority investors. In your, and maybe this is the point that I need to address. In your case, in early stage, it's important for you to, when you draft your term sheets, to make sure that you protect your minority investors at this stage. Otherwise, as you start raising, it will be difficult for them to liquidate, and it might create major problems. So make sure that you look at the short-term raise and you look at the long-term raise. It's usually fair for the minority investors who are coming at this stage to request certain protective measures that will protect them from major investments that will come in following rounds. It's really important for you to balance that as you are building, doing your fundraise. So the short term will be probably angels, small ticket investors that need protection in your term sheet when you continue with the fundraising. Control rights. Usually angel investors don't really have these, some of these in the term sheets or convertible notes, but VCs do. So their involvement in the board of directors, information rights is very important. Their access to your information. Reserved matters protective provisions is also a very important term that we usually make sure it's addressed. In most of the cases, we push for simple majority, which is 50%. But in many cases, there is a certain VC that's taking a very, very high risk. They push for unanimous decisions. Tag along, drag along, these are also important. These are you don't necessarily find those in any convertible notes. It's primarily in term sheets that are for priced rounds. It basically gives the minority investors the sort of the ability to tag along major investors and drag along sort of the authority that a senior investor has to drag along minor investors in the cap table. I'm gonna try to stop here, honestly. Before, like, 3 things I really want to address before we just sort of wrap this up, and maybe give a couple of questions or discussion points before we wrap it up. So really understand your leverage and try to create it. And that really starts when you start pitching your idea to the investors. You really have to understand your added value, your strategic value, and understand the synergy between you and the investors. That's a really important point. People tend to undermine it, but you really start pitching, or you start the negotiations when you actually start pitching. The second point, which is very, very important, is actually building trust. We see a lot of investors, a lot of entrepreneurs trying to sort of not being transparent in certain things. However, be sure that an experienced investor will do their due diligence, will challenge your assumptions, will challenge your financials, will go through deep due diligence, and a small discrepancy might like just stop the deal. So really try to make sure that you build the relationship based on trust. Be as honest as possible early ahead. Be transparent, because the less they trust you, the less likely they invest. And the final point is, which I really think is really, really important, is focus on value and valuation. And that speaks to a lot of the points we've addressed earlier. It's like, what is the right valuation? It's not really the answer. What is the value that this investor can bring to the table, in addition to the like economic value? What other aspects that I can leverage, and how we can create that successful partnership? That's it. Thank you very much, guys. I'm gonna stop for a short Q&A session before we wrap this up.
Thank you, Khalil, so much. يعني the value, not the valuation, speaks a lot. يعني I love it. And basically, most founders start focusing on the valuation at a certain point and forget about the value they bring to the table. And this is very important, because value speaks for valuation, not the other way around. Guys, please feel free to ask any final questions. We'll give you a minute to think out your questions and ask Khalil. Okay, apparently we don't have any questions. Nadine sent out the evaluation form for the session over the chat, so please fill it out. Also, a kind reminder that you can book a one-on-one session with Khalil to speak more about your company and your case. And Khalil, what an insightful session, great frameworks and tools and insights from an insider. So thank you so much for the valuable session, and that's a wrap. Thank you, Khalil. Thank you for being on time, guys, and see you soon.
Thank you, Rizal. Thank you, everybody, and appreciate it.